Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So if I had an asset that was trading at 16 vol, I would divide by the constant, which is about 16. It's really 15.9, but I'm going to say 16. That's going to give me my percentage change for the day, so 1%. So a couple months ago, when I built this slide, the volatility in the Canadian was 12. So I could take 12 divided by 16 and come up with 0.0075. Multiplied by the exchange rate value of 104 and come up with the expected top and bottom 68% chance would have been about 78 cents, assuming a 12 vol and 104 pair value. So I hope that is helpful. That's slide 24. If you want to go back, you can always come back and listen to the archive again. Please, at FX Options, so check it out. That's slide 24, and you can go right, I guess you can scroll right to it. Volatility, though, it changes an awful lot. So in 1987, I was trading on one of the floors of the exchanges, and volatility was, it was going absolutely berserk that day, and we saw volatility of, the market was down 17%, and I think in the S&P 500, so that was a 19 standard deviation move, which is really unheard of. Or 2 years ago, year and a half ago, whatever, we had a 3 standard deviation move, which is a pretty big move. Types of volatility, well, we have the historical volatility, which is what's happened in the past, and I'll show you some charts on that. The implied is what the market's expecting in the future. The actual, of course, we don't know what that's going to be. But we're hoping that we're going to be on the right side of this. So we're hoping that, again, if you're a buyer of an option, you hope that the actual is going to be greater than the implied today. That would mean that you have potential to have a nice trade there. It's a lot more challenging when the volatility is lower than you expect and you're a buyer of an option. And your forecast is very important on volatility because it's going to help you decide which strategy you might implement. So how do you look at these volatility? Well, you look at historical versus implied, implied versus expected, and implied versus actual. As a general rule, as assets drop, volatility normally increases. Not always the case with ISE FX options. I'm going to show you some skew charts, and you'll be able to hopefully understand how this all works out. But in typical equities, as the asset falls, you see higher volatility. The option premiums are made up of intrinsic value and extrinsic value. So the intrinsic value is what is the option worth if it were to be exercised immediately. Extrinsic is all other value. And the extrinsic value is based on interest rates, the interest rate differential, and volatility. When we're trading options, we're looking at expectations. Buyers hope for volatility to expand. Sellers hope for volatility to contract. It sounds simple, though. Volatility can change, and we've seen a reduced volatility over the last 14 or 15 months. So I'm going to show you some charts. These are all courtesy of livevolpro.com. I'd urge you to go check out their site. They have some free charts on. This is actually a paid, but it's not that expensive. All right, so here's the first one. Dollar yen, symbols YUK. So a couple things we're looking at here. I mean, when I look at assets, I look at number 1, the price. Number 2, of course, the trend a bit. Number 3, I want to know what's happening in volatility. So the volatility is in the lower pane. So what you're noticing as the dollar, this is dollar yen, as the dollar was dropping, so we saw a sort of a precipitous drop there in 2008, right over here. What was happening? Well, as the asset was dropping, you saw vol was picking up. You see that right here. So this is interesting to see how this one works out. Everyone's going to be a little bit different, but More volatile movement means higher option premiums. Dollar against the Canadian. So we saw a peak somewhere in December there of '08. And the U.S. dollar was rallying very strongly, if you remember. So this is the dollar against the Canadian. Saw a massive rally. And ever since the U.S. dollar started to sell off, what happened here? Well, as the U.S. dollar has started to move lower, interestingly enough, what's happened to vol? Anybody want to take a guess here? As the dollar has gone down, U.S. dollar against Canadian, what's happened to volatility? You can cheat and look at the lower pane where I have that amber line is the implied volatility. Is it heading higher or lower? Yes, the answer is lower. So volatility is moving lower. You can see that here. Volatility is going lower, so the expected changes are less and less. At least that's what the market's expecting. And this morning we were trading around at 100. Parity, par, whatever you want to call it. Par is for bonds, parity more for currencies. Euro against the dollar, symbols EUU. We've only had this symbol out there for about 7 months. So what's happened? This is so interesting. And this might be one of my most interesting points of the day, at least I think it's very interesting, is that no matter how much we talk about Greece and all the problems of what's happened in Europe and specifically Greece, the option premiums have not been moving at all in the euro. So even though the euro slid significantly, you saw no move at all in the amber line is the implied volatility, meaning what is the implied volatility is if I take an option price, I want to find out what volatility makes that price fair. So that's the amber line there on the bottom pane, and the blue is the 60-day historical volatility of the euro against the dollar. So even though the euro has fallen off quite a bit, the option traders are not all that scared about future movement. Very, very strange. Big move, but the option traders not all that scared. So you can draw your own conclusions. If you believe that the euro was going to make a big move, these options might be cheap. But if you look at what most option traders are saying is that they don't believe that the problems in Greece will continue over the next couple of months. They don't think they're going to be material. And the reason I say that is I just look at the implied volatility, not a big shift. So very interesting.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.